big headlines we're tracking for you on the Money Show. But let's get back to what exactly is it in terms of your money that we are tracking for you this evening on TMS. First up, small finance banks. Ujjivan Small, AU Small, Jana Small Finance, all of these names have one thing common, and that is small. But the interest rates they are giving are definitely more than small. In fact, for senior citizens, they can enjoy a rate of more than 9% if you invest in a fixed deposit by a small finance bank. So what exactly are the terms and conditions, if you could call it that? Is a small finance bank for everybody? And very first question is, how does a small finance bank like the ones that we have listed out here differ from your HDFC Bank, ICICI Bank, so on and so forth? To talk about this and more, we have with us Anil Rego, founder and CEO of Right Horizons. Mr. Rego, thank you so much for joining us on the Money Show. We just had those interest rates appearing on our screens a moment earlier, and if you look at it, the 1 year interest rate of all of these banks are more than 8.5%. So, Mr. Rego, I would like to start off first by understanding, and then we can talk, more in depth about the other topics. How does a small finance bank differ from a regular bank like an HDFC Bank or an ICICI Bank, so on and so forth?
Basically, a small finance bank is a niche bank in India. There was a separate regulation by RBI which allowed small finance banks, and a key objective of RBI was to try and focus on small scale sectors like SMEs, unorganized entities, individuals who would like to borrow and run their businesses. So basically, a small finance bank is a bank meant to take care of some of these smaller entities which may not get taken care of by some of the larger banks. And so typically you will find smaller finance banks give smaller ticket size loans. They also have smaller size deposits, etc. So it is trying to take care of the next segment, which possibly the larger PSU banks and larger private sector banks take care of.
All right. So, Mr. Rego, how is it then that these banks can offer a higher interest rate to customers for the fixed deposits and other deposits as opposed to maybe your regular bank?
Yeah, so I guess one thumb rule is they may not have the credit worthiness of, let's say, an HDFC Bank or sort of an SBI. Okay, so you will find that even on the private sector banks, when you find smaller banks, you may find a higher interest rates. So on similar terms, you will find, these small finance banks have a slightly lower credit quality, and hence they offer, interest rates to depositors which are a little higher. The second key aspect of it, and this is what RBI also is trying to do, is to try and find, some of these new age banks which possibly use technology a lot better and, have a very tight and low cost structure, and because they are new, they can plan their bank that way, and so it not necessarily needs to be only about credit worthiness of them, but also because they manage their own internal finances a little more tightly. They end up coming there. Plus, they also lend to smaller ticket loans, etc. So you will find, again, the guys that they are lending to, they are able to lend at a slightly higher interest rate as well, because they are smaller than maybe some of the large corporates which borrow.
Okay, now it certainly is very tempting, right, that if these small finance banks are offering deposit rates of more than 9%, 8.5%, let's just say that, up to almost 9%, for a 12 or 18-month time horizon. But it's at that point as well that we should have our antennas searching for any sort of terms and conditions or asterisk that has been put. So in this case, Mr. Rego, is there anything that our viewers should be cautious about before they decide that, okay, I'm going to go for this FD in a particular small finance bank?
See, like today with making any debt investment, including, let's say, a company deposit or even today a bank itself, I think one key aspect that they need to look at is what are the credit worthiness of the bank. and that becomes a very, very important factor. So how creditworthy is the bank, which means how safe is your money. So if you are investing in an FD, you're probably looking at it from a lower risk perspective. So I think the first aspect you need to look at is, how creditworthy is the bank. The credit rating is something that you can look at. Typically, you will find some of these at, a double A or double A plus, double A minus. You may also find A plus. So, ideally look at a double A plus type of rating. The second aspect to look at it is, what is the interest rate that they are offering? Do you get something which is closer to that at a similar or better level of risk? And then you would sort of go and use that particular avenue. The third is, how easy it is to exit, because if you need money in your bank, it's very a lot easier. Of course, you have exit interest rates. You need to look at that as well. And so I think these are 2-3 factors you need to look at, before you sort of start investing into some of these banks.
Okay, all right. Now, when one does want to select a small finance bank to put his or her money in, now the question is, how should you select it? Sometimes the data, like you mentioned, like the credit risk profile of the bank, is not so easily available. So could you give our viewers some more easier aspects to understand, some parameters that the banks should take before the viewer makes the decision that, okay, this bank looks okay for me to put my deposit?
I think the credit rating is still one of the easiest things to do, because maybe investors will not be able to look at what is the profitability, balance sheets, etc. I think if you are able to, that's also a good way of looking at it. You look at how profitable are they, for how many years are they profitable. If you are able to look at ratios a little bit, debt equity, etc. But I'll stop there because it may get a little too complex for people. But credit rating is definitely something which will help you a lot more. And AAA is sort of the best credit rating. Ideally you will not touch something which is less than an A. So like I said earlier, something which is AA or higher is what I think you can look at as a simple thumb rule. AA plus is something that you can also look at, and possibly stop there. The second aspect is, when you're looking at banks like these, don't put all your eggs in one basket. Okay, so look at maybe diversifying across 2 or 3 of them. And the third aspect, again, when you're looking at it, is to say that, okay, let me cap my overall exposure to the SMBs, right? So you can possibly keep a cap depending on your appetite. If you are a senior citizen, etc., even though you may love to have a higher interest rate, you should be looking at actually a lower risk. So look at lower risk levels. But if you can take a higher risk, maybe go up to 15%, maximum maybe stretch it out to 20. But ideally, I would think anywhere between 10 to 15 is where you can expose yourself to SMEs.
Mr. Rego, you mentioned that credit risk profile, and you think that would be the most easiest for our viewers to understand. So could you help us with where we can find it? Is it on the RBI website, or if we request the bank, if you could share that with us, where we can find this information?
The bank itself may give it to you, number one.
Okay.
But I think today you can just go and do a web search, Google, and you will find it. The name of the bank, credit rating. I think you should very easily find the latest credit rating of it. Okay. You would find it on RBI sites now. It may be a little more difficult to get it there. Where do you find it, etc. So I think just a Google search should be the easiest way to get across to what's the credit rating. Of course, the banks also need to publish it. So when you're making a deposit, you can also go and ask for it. So either of these mechanisms you can do, and you can easily find the credit rating.
Okay, all hail Google. That means just all you need to do is simply punch in the name of your bank and write credit rating, and I think you will get a plethora of information. By the way, Mr. Rego, what should be the minimum? If there's any benchmark that they can compare it with?
Like I said, a AA plus is what I would prefer. Okay, and maybe AA minus as well. But beyond that, I think you should not go to a lower credit rating is what my perspective would be.
All right. Now, Mr. Rego, a regular bank, if in case you want an early maturity of your FD, many of them don't even charge us a penalty now, but, charges as well, even if they are there, they are minimal. But are the rules different for a small finance bank?
Yeah, so like in the case of, a normal bank, you'll find different banks have different methodologies. You'll still have, even in a particular private sector, larger bank, you will find, or public sector, you will find exit clauses there as well. Okay, so it's important to go and check it because you may be impacted in two ways. One is some sort of an exit charge that may come in. Okay, the second would be that it would get reset probably to the lower tenure that you are for. So, for example, if you enter into say a 2-year deposit and then sort of you terminate it in the end of 6 months, they will look at what is the interest rate for 6 months at that point of time. And so if interest rates have gone down further from where you started, you may find a lot lower interest rate there. Okay, so look at both of it. How do they calculate interest for you once you exited, number one, and is there some exit charge that is there? So both of these are what you need to look at before you make up your mind.
Okay. Mr. Rego, since we are talking about small finance bank, I would like to talk of the other commonly used feature as well for a lot of our viewers, and that's savings account. Does that exist in an SFB? I mean, how does that work, and would you recommend our viewers choose that?
I would think that for normal banking, I would rather suggest to use a larger bank. Okay, so basically that gives you a lot more ease as well in terms of using your network, etc. Okay, so I would think that for SMBs probably restricted to the fixed deposits.
Okay, all right. Well, there you have it. That's all about the small finance bank, how you can choose it, what are the terms and conditions, what are the risk factors as well associated with it. Okay, actually, Mr. Rego, I have a quick question as well. Now, we did see what happened with the PMC Cooperative Bank, and now many are perhaps asking for the deposit credit guarantee institution to come in and reimburse the depositors. I'm assuming that in a very worst case scenario, that institution will stand for even the SFBs. Am I right?
Yeah, so they need to take the insurance, the deposit insurance scheme. Okay, so they will also have the benefit of it, but like all of us may be aware, that is to the extent of 1 lakh rupees only. So if you are investing higher sums of money, then you must be aware that what is protected for you is 1 lakh of rupees.
All right. Okay, well, thank you so much, Mr. Rego, for that. Now we'll do one thing. Anil Rego will still be with us, but he will be here to answer all your questions and queries. So, folks, this is our Ask the Money Show segment. So, if you have any queries on small finance bank, on your personal finance journey, or your wealth creation journey, your mutual fund portfolio, write in to us, or even better, call in on the number appearing on the top of your screens, 24990300, and we will get them answered right here. For now, and while our calls accumulate, I'm going to take on board our very first query, which has come in via email. We have Mr. Vishwanathan from Chennai, who is writing in to us saying that I am a senior citizen and I have a total of 3 lakh rupees, 1 lakh deposit each with different small finance banks. Would like to check how safe is the investment. Now, unfortunately, he's not mentioned which small finance bank he's invested in, but he's a senior citizen and he's invested 3 lakh rupees. We don't even know the corpus, or if we don't know if he's relying on this money. But yeah, all in all, any tips that you'd like to share with him on how he could make this decision for himself?
Yes, so it looks like he's already invested that money and he's put it in 3 banks. The good part of it is he's sort of restricted it to, I'm assuming, 1 lakh each, which means that he has the deposit insurance scheme which will sort of protect him to the full extent. If he's put a larger in one, etc., then there may be a bit of a problem, but I'm assuming that he has put similar money and all. So that's the best part of it. So it but if somebody is looking at, say, a higher sum to invest in, and let's say you're a senior citizen, I think you should restrict it to overall 10% of your portfolio, that is all your investments put together. The second is, I think he's done a very intelligent one in terms of diversifying across three different banks. So continue to break it up across three different banks and restrict to 10%. The third is possibly look at the credit rating. Like I said, anything which is a AA plus. Ideally, those are the type of small finance banks to look at. So even if you are looking at a slightly higher amount to invest in.
All right. Okay. So, Mr. Vishwanathan, I hope this conversation as well that we've had with Mr. Rego is something that will help you take your decision with respect to the 3 lakh rupees lying in small finance banks. Of course, it would have been great if we had the names of the banks that would help us, give you more specific advice. Okay. Let's take on board our next query coming in from Prince Kamboj. He's from Karnal and he writes into us saying, I'm 34 years old, have been investing in direct and growth mutual funds for the last 2 years. So he looks like he knows what he's doing. 19,000 rupees per month via SIP in 5 funds. The Mirae Asset Large Cap, the SBI Magnum Multi Cap. We have Axis Long Term Equity, which is an ELSS, HDFC Mid Cap, Reliance Small Cap. Now his monthly income is 70,000. So of that, he's investing roughly around 20 odd percent, 25 odd percent. So that's not bad. Now the question is, in case if his cash flow increases, which in this case we hope it means salary, should he step up on his existing SIPs or should he buy new ones? That's his first question. And the second question is, of course, he wants to know if there are any changes you would recommend. He has 2 goals. He wants to buy a home for himself in 8 to 10 years, and the second is his child's education, marriage, retirement corpus. That's more long term, that's after 25 years. He also does have a term insurance of 1 crore, a corporate health insurance. So that as well is something, that he does have. So his third question is, should he get a personal health cover and critical illness cover as well? Plus he has 5 lakh rupees in fixed deposit as an exigency. Okay, so he's listed down everything for us very well. So, we can take a comprehensive view of his portfolio and give him a sound advice. Mr. Rego, what would you recommend? How would you look at the funds he's chosen? Is it sufficient for him to build the corpus and achieve his goals as he's mentioned?
Yeah, first of all, I'd like to congratulate him because I think he's done a very structured investing process. In fact, what is interesting is, his large cap SIPs are larger and as he comes and multi-cap, but as he comes down to the mid cap and the small cap he sort of reduces it. So I think it's a very good and diversified way to go about it. Secondly, I also believe that the funds that he looked at is reasonably good. So there's no need to fiddle around with anything else. Having too many funds in your portfolio makes it more difficult for you to track. So I would suggest just continue with the same funds. You could increase into them itself. Okay. Now, if the only thing I can look at is he can maybe increase the debt component a little bit. Okay. He is 34 years, so he can afford to take a bit of risk. Of course, the other intelligent thing that he's done is to keep 5 lakhs in a fixed deposit, for liquidity purposes. But I think having debt in your portfolio also to take advantage of market volatility at these points of time. Say if market falls, you can move some money into equities on falls, etc. So I would think that he can maybe at least go towards 20% debt allocation, especially in his increasing SIPs. Or where he has got some good profits in his portfolio, he can book profits and keep that into debt and maybe use debt mutual funds. I would suggest debt mutual funds like ultra short-term funds, an Axis Banking and PSU debt fund, which is slightly can be a longer-term investment on the debt side, but an ultra short-term fund for liquid needs, I think would sort of take care of him. The other fund category that he can look at also is, I think, a dynamic asset allocation category, and he can look at maybe dynamic asset allocation fund from either Kotak or ICICI. So congratulations again, and I think very well done. Maybe just one point I missed on the insurance side. Yeah, you can take a separate term cover, and you already have it. from HDFC, and I think that's a good thing as well. The question on, the health insurance, definitely it is a good idea to take as an independent health insurance cover apart from, what your company gives you. Maybe you can have a critical illness rider along with it, and I believe you're very well taken care of. You planned well for both risk and return.
Okay, so Prince, I think you've done a great job in sort of making a very structured portfolio for yourself, so keep that up. Okay, very quickly, let's take on board a live caller that we've just got. Vinod from New Delhi is joining us on the phone line. Hi Vinod, good evening. What's your query?
Yeah, I have basically two questions.
Okay.
One regarding the dividend reinvestment plans of the mutual funds. Whenever I get the dividends and they get reinvested,
yes,
and after it is done, the total amount, since the units are allotted, the total amount should not get reduced.
Okay.
Let's say if it is X amount, after the dividend is issued and reinvested,
yeah,
it becomes X minus some amount.
Right.
And that's one worry. Since I was thinking of redeeming those, I'm thinking whether I should be redeeming before the dividend is issued, or I should wait for the dividend and then redeem it. And second question is regarding the 3-4 value funds.
Okay.
And they have not been doing well.
Okay.
Like Value Discovery, 1.5 year. Then UTI is also some of them, and Quantum Long-Term Equity Value Fund.
Okay.
Things like that. So I was thinking of redeeming them, and especially this one also, which was earlier Prima Plus, which is now Franklin.
Yes. Okay.
So can you give me the details, or what is?
These are the funds you've invested in. These value funds, are they the only mutual fund exposure you have?
No, I have a host of other mutual funds, maybe 20, too many funds actually.
Too many funds. Okay, all right.
I was trying to get rid of the ones which are not doing good.
Okay.
The other ones which are doing good,
you want to stay on.
Keep them for some time.
Okay, all right. Okay, so Mr. Rego, his first question is a bit technical. It's about dividend reinvestment. He wants to understand how the mechanics work, and of course you understood what his worry as well is, that it's getting subtracted. And secondly, value funds, that has not been performing well. So if you could help him with that, and also would you advise him to keep so many funds in a portfolio, because one mutual fund itself is already diversified in, the 30-40 odd companies. So when you're literally having 20 funds, it's as if you're owning the whole market. So what would you recommend Vinod do?
Yeah, so I think at the first level, let me answer this dividend reinvestment question. And so basically, there is a dividend tax that is there, which sort of gets deducted. Okay, so that is what is sort of taking away some bit of the returns. Post that it becomes sort of tax free. So however, what may just happen is over a period of time, you may find that you may be able to set that off against, other, taxable, because even today the long-term capital gains is taxable as well. When you have a dividend, after indexation, we typically see that, you may even see a bit of a negative there, which you can set off against, especially if it's a debt scheme. On the equity scheme, if not all of it is distributed, then your capital gains when you sell it may be a little lesser. Okay, so effectively, you need to come back and look at from a taxation perspective, what is beneficial for you. If you are in the lower tax brackets, then maybe a growth option. Anyway, you have a 10% long-term, 15% short-term tax. Okay, versus that you have the dividend, the distribution tax which sort of plays in. So I would think that one versus the other in the longer run may not make a difference too much, other than if you are exiting a lot in the short run, in which case dividend option, dividend distribution option may be a little more effective as well. So I think it doesn't make a difference too much between the two. Should you exit before dividend? I don't think so too either, because to the extent that tax is deducted at first, you will not end up paying a tax on that amount when you redeem it. Okay, so that's the first step. The second point is about some of his other funds that he has. Yes, no question about it. Some 25 funds is definitely too much. Okay, it's very, very difficult for you to track. So what I would suggest is, cut down to a maximum of maybe 8 to 10, because even each of the funds already is, across some 25 different securities. So it doesn't make sense to diversify as much. And too much of diversification also does not help you reduce risk, beyond a point. So that's one. The other aspect that you requested for is, some of the value funds, and you have different points of time, different themes play out for you, right? So in this last few years, the value funds have definitely underperformed because
Mr.
value.
Rego, you know what, Mr. Rego, unfortunately, I'll just have to interrupt you because we're completely out of time. And I'm sorry, Vinod, we're not going to be able to complete your query, but why don't you write in to us and we'll be sure to take up your question on the Money Show itself. But Mr. Rego, thank you so much for joining us and of course very patiently answering all those questions and queries. We'll take a very quick break, but before we let you go and before we take that short break, tomorrow is a very special day on the Money Show as we are celebrating marriage and wedding, but the more trickier part